Thanks for having us on again today. Pretty much consistent with what you said in your opening comments here. We did have a record year this year, and obviously you can focus our comments on Europe as we go forward. And I do think the expectation is, by any kind of metric, when you're coming off that kind of a record year, I think it's prudent to assume that you're probably not going to be able to quite sustain those types of levels of activity, particularly as you noted in the opening comments, since so much of the volume, both in 2021 and the expected volume in 2022, will be tied to M&A transactions, which, while all the building blocks are there for another tremendous year in M&A, particularly in leveraged finance M&A, there's no guarantee that those transactions will be able to come together in the current climate. And as you noted, importantly, from a volume point of view, 2021 in Europe, in any event, about 40% of the volume in leveraged loans and high yield bonds in Europe in 2021 was due to refinancing activity. And if we do get a slowdown in that, as you note, because conditions aren't quite as conducive as they were, particularly in the first half of 2021, that should lead to a slight diminution in terms of volume going forward in 2022.
Well, Ben, there is a question around whether corporates look to front-load issuance, particularly in the U.S., given the expectation that it's going to become more expensive to raise debt in the future. Here in Europe, the ECB is obviously on a different path when it comes to monetary policy. Are you expecting to see any front-loading here in Europe when it comes to issuance?
Yeah, it's a fair question. We are seeing a bit of a dispersion between the two markets now, between the U.S. and Europe, where the U.S. is clearly the Fed is on a path to raising rates fairly aggressively over the back half of 2022, at least in our forecasts. And I think the market is certainly onto that theme, and there will be more front loading in the U.S. than in Europe. You mentioned before in some of the opening comments at the break there, the Omicron having an impact on the European economy. So there's definitely less of a push to have rates go up in Europe. So I think that theme is probably going to resonate a little less in Europe. That said, I think if you are looking at the U.S. as the engine of the global leveraged finance train, and you are going to see that kind of pressure in the U.S., there will no doubt be a number of issuers who look to lock in what could be low tick rates here at the start of the year. I mean, if you look at where the index yield is in Europe right now at roughly 3.25% for high yield, that's about where we entered 2021. And we exited the year there after having gone significantly tighter over the course of the year. So I think you're probably not going to expect tightening in that index between now and the end of the year. If anything, there will be a bias to that going slightly higher. And whether that's a combination of base rates going higher or spreads widening a bit, it does seem like the first half of the year would be an opportune time to lock in these tighter levels.